Welcome. In this course, I'll show you how you can make 2 to 5R in Forex. So if you are a beginner trader and want to learn how to trade, or you are a break-even trader and want to attain consistency, this course is for you. I know you are asking, why should I enroll in this course, or why is it worth taking the course? The answer is simple. The concepts work, and you can prove the concepts from your own chart that they work. The only thing that you need to do is to take time and make these concepts a repetitious drill for about 3 to 4 months and see that they work. I know most traders deviate from the strategy that they use, but the only thing that you need to focus on is this strategy for a period of 3 months in your demo trading. So you have to do demo trading and back testing and forward testing in your own charts to prove that these concepts work. And also you have to, in your demo chart, you have to come to the realization that you have made profit from your account in the demo. So if you have not enrolled, please enroll and let's see one another in the course. Thank you. Welcome back to this lesson. So before you start this course of how to learn this strategy, I'll be able to guide you on what you can do and where you can put your focus on this strategy, so that as you continue and as you start this lesson, you'll be able to get the most out of it. So first of all, I want to encourage you that you have to understand that this strategy, it does not require any other, it does not require you to mix it with any other strategy. So any other idea or any other strategy that you've come up with or you have been in contact with before, I'll just ask you not to mix it with this strategy. So you should come with a fresh mind and don't expect that when you learn this strategy to mix it with the other strategies that you've come up with or you have been in contact with before. So just I'll ask you, come to this strategy with a fresh mind, so that you may be able to get a fresh perspective of this strategy and it will be able to work well for you. The next thing, this strategy that does not require indicators. So as we start this strategy, I'll show you that the only indicator that you need is the trading view indicator, which is a daily separator to separate between the days, so that as we continue on, you may be able to see every day in the different time frames. But the other indicators like RSI, we do not require RSI indicators for you to be able to be profitable from this strategy. So I require you not to engage or incorporate other indicators in this strategy. The next thing I'll ask you as a trader, as you start this strategy, you have to play your part as a trader. And by playing your part, I require you to do more practice before live trading. And the other thing is, don't live trade before or after you have finished the strategy. So there are steps and a guideline in which I'll be able to guide you into, but as you start this strategy, it is required of you not to engage in a live trade or enter into, maybe you may demo trade first but not live trade. So for those of you who will come into this strategy thinking that immediately after you're finished the live trade, you are required to go to immediately you have finished the strategy. For those of you who think that you will go into live trading, this is not it. It is not. You are not supposed to go to live trading. First, we have a process. You are supposed to demo trade. You are supposed to backtest, forward test, demo trade, and live trade, and it requires a period of time. I would say like 6 months to do all those things. So, as a trader, I require you to be patient. Don't come with other ideas from outside which you have learned. Just come with a fresh mind. Then do your part as a trader. Whatever I'll show you, you need to learn from here and practice. You have to do your part of practicing. We cannot expect to learn this strategy today and tomorrow you be live trading or go to engage in the market using this strategy. Even demo trading, you are not supposed to demo trade first. It is back testing. So you have to go into the market so that you may become familiar. Go into the markets, practice, so that you may get familiar with this strategy, and in the end you'll be able to see consistency. The next thing, as a learner, don't seek approval from online groups or channels. And this is especially for those who are in online groups, example for signal groups or YouTube channels, those who follow those who are in live. This will hinder your success or your growth as a trader. So I encourage you not to seek approval from those groups. It will make your growth become slow, or in the end you not see or find that growth at all. So as a learner, don't seek approval from online groups or channels. Yes, that's it. So it's up to you as a trader to focus on this strategy, and I know in the end we will be able to see that consistency and the growth from this strategy because it works. Thank you. Hello and welcome back to this lesson. In this lesson, we'll be talking about the setting up your trading platform. And in the setting up your trading platform, we'll be looking at the time zone. So on the far corner, right side of your trading view chart, you'll see that there's a time zone. So you click on it. You'll see that there are different time zones, UTC, but the one we want to consider in this course, it is the UTC -4 New York zone. So you are going to click on it, and this is the time zone that we are going to be setting for our course through the entire course. Thank you for listening. Welcome back to this lesson. In this lesson, we'll be setting up our trading platform, and we are going to be setting up our day and weekend separator so that we may be able to differentiate our different days from Monday to Friday and even the start of a new week. So we are going to go to the indicator part, click on it, and search for ICT period separators by Unknown Unicorn. This is the one. So I'm going to add it as my favorite and also click on it. So when clicking on it, we go back to our trading chart, and we are going to identify it on the left side, the upper part of our trading chart. So on this part, we are going to click on settings so that we may be able to set up our indicator, because we can see on the chart it is not yet visible. So you click on the setting part. You start on the first part, which is the week separator on day. This one we are going to adjust it to Monday. Okay, the next one is the show week separator line. You want it to remain up. Yeah, you click on it. The second one is weak line color, which is this dotted yellow. So default, change it to black. I prefer it to black, but you can use any color that you want. So you can see it is appearing here. The third one is the show day separator. You want to click on it. The fourth one, you want to click on show day separator and days of the week on 1 hour chart, so that when you go back to your 1 hour chart or any time frame lower than the 1 hour, you'll be able to see the time separator. The other one, this use background separator, you just leave it open. The next one is show day of the week. Yes, you click on it. The next one, use short names for days of the week. For those who prefer short names, like me, click on it. But those who prefer long names, you may leave it like that. And then the text color on Monday to Friday, you choose your preferred color. Mine, I'll choose black. On each and every day, from Monday, Tuesday, Wednesday, black, Thursday, black, and also Friday, black. You can see that on our chart, the lines or the separators, they are starting to become visible. The days, they are visible also. So you click on OK. And yeah, this is how it will look like in the end of the adjusting. So that is the end of our lesson for setting up our indicator, the week and day separator. Thank you. Welcome back to the lesson. In this lesson, we are going to learn on time sessions. Our focus will be time sessions, and the key focus of our time session will be looking at the London session, the New York session, the Asian session, and what typically normally occurs at these sessions. So first, when we start with the London session occurs between 2 a.m. to 5 a.m. So in the London session, this is where we usually, most of the time, the market forms either the low or high of the day. You may come to get high or low of the day in these session zones. It is high probability, not a must for the market to form high of the low, but it's just a high probability scenario where high probability it creates the high or low of the market depending whether we are bullish or bearish in that day. The second one is the New York session. The New York session occurs between 7 a.m. to 8 a.m. So between this time, you'll get that either the market may retrace back into the London session to provide opportunity for further movement, or we may also get a reversal away from what the London session was doing. The third one, the Asian session, normally we may also see the start of a move created in the Asian session, but normally in this lesson, yes, the Asian session is ideal, but I may say that we'll not focus a lot on it. So we'll focus a lot on the London session and the New York session. So to come and show you examples in the chart for you to get familiar with the time zone. So any time outside these session zones, I'll say it creates low probability scenarios for your trade opportunities or trade ideas. So when you get, I'm not saying that you'll not get opportunities in these sessions, but outside these sessions, maybe for example between 5 a.m. to 7 a.m. But what I'm saying is that London session and the New York session or the Asian session, these are the time zones in which there is high probability scenarios for the market to respect our strategy, to respect even the movement. So between 5 a.m. to 7 a.m. I may advise you to stay away from that time, or from 11 to around 3 a.m. or to that session in the Asian session. So we'll come right to show examples in the market. So we can see that this day it was on a Monday. Let's start on Monday. We can see that. So I'll demonstrate areas or scenarios in which you'll be able to come into the market, and since the focus is the London and the New York session, we want you to get familiar as the learner with these session zones. So I may advise you, at least maybe for the next 3 months, let your mind concentrate on these time zones. So for example, what I may advise you to do is either you may set up an indicator, or what I prefer to do is do it manually. Every day you come, maybe you, from this rectangle, you highlight the time session between 2 a.m. to 5 a.m. So from this time, you want this whole time your focus to be on the chart. So you can see that this time, let me outline it with, so that we may remember that this is the London session. So this is London. So I advise you to do it manually without indicators, for you to outline this every single day, so that you may be able to get familiar with your time zones. The next one was our New York session. So our New York session starts from 7 a.m. to 11 a.m. So up to there, and I'll probably outline it with a different color blue, so that we may be able to differentiate between these sessions. So this is New York. New York session. So I've said that in the London session we may get, like here for example, we can see that from 2 a.m. to the market expanded from the London session, and it made the daily range during London session. So it's up to you as the trader to be available during this skill zone, because you can see that, for instance, during this day on Monday, the market made the low of the day during the London session, and in New York we consolidated. So not a lot of activities happened during New York. Yeah, that's it for Monday. We go to the next day. We want to monitor, by these boxes, we want to monitor the behavior each and every week, each and every day, of what either the London or the New York is doing. Oh, I've remembered that I've not highlighted the Asian session. So Asian, we have said it starts from 2000 or 8 p.m. to midnight. We can see that even during this day, let me outline it with a different color so that we may not get confused. Color green. It has not changed. Yeah, color green. So this will be Asian session. So this will help us to understand how the market moves each and every day, the impact it makes, and when you come back, even after the week has ended, you'll be able to notice what the market does in each and every session. For example, here where we got an expansion and the low of the day. So the next day, you can see, let us outline it again from 2 a.m. to 5 a.m. I know it seems a lot of work, but in the end, it helps you as a trader. So I'll clone the London session so that it may become easier. And you want to do this every single day so that you may be able to know when typically when you are trading, you may be able to know when you're outside the daily range, the daily time zone, so that you may not trade outside the session zone. So this was the start. So for example, if we see that, we can see again during London session, we made the high of the day here. Let me clone also from the previous day, the New York session. New York session, we have said it starts from 7. So from 7 to 11. So you can see we got a move back higher, then we collapsed lower, making the daily range during New York session. So you can see that on this day, on Tuesday, we moved out further during the New York session. And then the other one will be the Asian session. So in the Asian session, you have said that it ends at midnight and start at 8 p.m. Yeah, that's it. So our key focus will be during these sessions, and when you highlight your sessions like this, I think it will be easy even for your mind to be able to stick and to trade within these session zones. Yeah, that's it. So as the learner, I would advise you that every day, or go also into your, when you're doing practice, just be outlining your session zones until you master this skill, until it is stuck in your head that these sessions are usually from 2 to 5 a.m. because most of the time you find the trader or the learner makes the mistake of trading outside the kill zone when they think they have seen the setup, and maybe you find that that setup is outside the kill zone, so it ends up making the trade be a losing trade. So I'd advise you to start in your chart, be outlining your session zones like this, because yes, you may have the indicator, but it's also good to make your mind remember these things. Thank you for this lesson, and I hope you have learned what you may do from now on, and thank you for watching. Welcome back to this lesson, and thank you for coming back, guys. So in this lesson, we'll be discussing on the importance of journaling. So okay, there are different ways that you can journal as a trader. So if you are a beginner and you are in this journey for the first time, I'll advise you to have a place where you can journal, either an online or physical platform. So for an online, I prefer it to document these pictures because they occupy a lot of space, and coming to record physically, it is tedious. Another thing, I prefer even a physical journal to record day-to-day activities that maybe they have grabbed my eye, or I want to remember, or I am asking myself a question as to why something has happened which is new to me, which may come to, the answer may come to me in a while later on. So as a trader, there are different platforms. Even when you go to online, there are different platforms that you can journal in. You can go search for journaling in your website or in your, wherever that you search. For me, I prefer to use the OneNote, but there are other platforms that you can use. So it's not limited. You are not limited to this. It's just that I want to show you an example of where you can go and journal. So I also have a physical book or physical journal where I record other stuff, which for me, I find them important, maybe to look at the end of the day or maybe at the end of the week. So when you want to document information, or you have seen something in the chart that maybe you'll not find the answer to that question. Maybe you have a question from the charts, but you don't have the answer to that question that day or even maybe that week. So it's good to record so that when you find the answer, or because that question will be in your mind, in the end you'll come to find that answer, because in the end everything will be answered back to you from the charts. So I'll show you an example of how you can document your journal, or how you can journal. This is the online platform, not the physical one. So it's up to you. But as a trader, you have to have a journal to record your day-to-day life as a trader, your day-to-day activities of the chart of the market. So coming to from the strategy that you'll be learning, just an example, if you maybe your interest is to record or to study, or you are trading the imbalances, the fair value gaps, the breakers, the order blocks, whichever strategy that you use, it is important for you to always record them. So I'll be showing an example of the person who records whose strategy is maybe the fair value gap, the daily fair value gap. So using this platform, I also use the TradingView. So using this platform, for example, I can see here that we have a daily fair value gap. I'll just be showing, not the deep, I'll not be teaching so much concerning the journaling. I'll just be showing you how you can journal. But if you want more information, either you can contact me so that I can guide you. But here is it. Here is the way that you can journal. So, for example, on the daily chart, we have a daily fair value gap. So you annotate. So for example, it is on this day that you are trading. You can see that just from here, we have the daily fair value gap. So how I do it is I just come and take a snapshot here. So when I take a snapshot, the copy image, I go back to my journal, which I've told you I use the OneNote, but there are other platforms. As you can see, what I have the daily, from January, February, every month. So it is up to you to start to create that discipline. I know it will be difficult at first, because even for me, it was difficult at first every day to record. Some days I used to skip, I cannot lie to you, but maybe at the end of the week, I had to come back and journal and record the days that I missed. So when you do it for the first month, the second month, the third month, I assure you by at least the fourth month, it will be very easy for you you'll feel like when you have not journaled, you feel like you are missing something. So start it, you'll be able to get the consistency. Yeah. So like October, because we are in October right now, October, okay, I think some of the things, yeah, it is loading. So October, today is the 23rd. So you record also the pairs that you are interested in, the pairs that you trade. So you add a page. When you add a page, it should go back to, I like them in order. So it should go to record 23rd and the pair. It's not a must that you do it like this. So today also it is on a Wednesday. You can have your own format of doing it. Then from there, take a snapshot and you will extend. When it loads, when it syncs, you'll be able to maximize. So you can see the advantage of having a journal. You can see, like for me, since January, sometimes I come back to this data and you can see like the January of, I think January I started trading in the 11th. So you can come back and study something. So I start from, like here was, because it was a new month, you start from the monthly. Every month I prefer to start from monthly annotations to weekly. Okay, yeah, to weekly, to the daily, to every time frame that I trade, to the 4 hour, to the 1 hour, then up to the 15 minutes. Yeah, and then every activity of that day that I was doing. So as you can see, this is what I was doing since January. And I can say also that when you do it for a long period of time, the things you come to notice that the things that you used to journal on maybe a year ago, they are so much different from what you journal a year later, because you'll have grown even into the things that grabs your attention in the market. So as you can see, in January, I've seen that I used to record like the sell stops, but for now I don't record sell stops because I see them, they are automatic. So the only thing that I record is just the breaker. So there are things that I don't record right now, especially when I think the growth comes and some things you don't do, like these sell stops, the midnight open. You have to record the midnight open, but for me, it became obvious for me. But I'm not saying that I started in 2024. I started some years back, but I'm trying to show you the growth or the journey. You can see here also record. Also, I was also recording sell stops here at this point. Okay, live executions and whatnot. Yeah, but when you come to daily logs of October, they're so much different from what I'm recording, from what I used to record in January. Then also the importance of having a book, a physical journal, is for the purpose of, there are questions that you get to ask yourself, why has this occurred like this? So when you get that rhetorical question, you don't have an answer, but you are curious as to why the market has done such a thing. So you need to record that question so that later on you'll get the question, or even if not later on, but sometime after, or maybe in online you may go and Google, but I prefer it for you to get the answer yourself, because every person online has their own answer to a different thing, but it's better for you to have that answer for yourself and come to get to know why it has occurred like that. So also an important factor when journaling, in journaling you'll be able to discover the progress that you've made, especially in your strategy. You'll also be able to come and discover different things even from the market, and that's the importance of recording, so that, and when you record that thing, it will not escape your mind, so it will become part of you, and you'll get many things to ask yourself later on. So it is better for you to record. So online there are different platforms that you can journal. For me, I use the OneNote. You can go Google whatever place that you find comfortable to journal, but every day, even in your physical journal, write something, document something, because for me, let me say it that the journal has been able to make me grow even faster, and even to record success. Yeah. Thank you for watching, and hope you find this beneficial. Let it not be something that you pass over, but you start doing even before you learn the strategy, so that you may get familiar. Yes. Welcome back to this lesson, and in this lesson we'll be explaining about a fair value gap. Okay, what is a fair value gap? A fair value gap is a gap that shows inefficiency, or also we can say that it is an imbalance in which market can come and rebalance, so that to fill the inefficiency. Okay, a fair value gap is created when you have a set of 3 candles, consecutive candles, for example in a bullish trend or a bearish trend, and in the set of those 3 candles, the first candle, it's weak. It's the gap between the wick of the first candle and the wick of the last candle. So I'll be showing you an example, or different examples in the chart. So for example, I'll have one which is here. You can see that there is a set of 3 candles, all in a bullish trend, and the first candle, the wick, the highest high, and the last candle, the lowest low, the wick. So that gap is the inefficiency, which is called the fair value gap. So here an example is this one, so I'll be naming it as fair value gap. We can see different examples, not only this, but we can see the second one, which is this one. You can see that there's a set of 1, 2, 3 candles, and in a bullish trend we can see that the fair value gap it tends to be characterized by heavy buying here in this bullish trend. So the second one is here. I'll train all of them in this chart, in the daily chart, and it is not limited to the daily chart. You can also find them, or you can go and identify them in the 1 hour chart, 4 hour chart, all the time frames. You find fair value gaps. The third one is this one is a fair value gap, and we know that, or I can say that the fair value gap tends to be rebalanced, so that has to clear that inefficiency. There's also this one. You can see that here the market retested this inefficiency. The fourth one, or the fifth one, you can see is this one. Now you can see that here the market is a set of 3 consecutive candles, and in a bearish trend. So this also is a fair value gap, which was also retested here. The sixth one, it's also here. Yeah, that is those are examples of fair value gap. You can also go in your chart and identify for yourselves the examples of fair value gaps. Okay, that is for today's lesson. I hope you have understood the examples of fair value gap or what a fair value gap is. Thank you for watching. Welcome back to this lesson. In this lesson, we'll be learning on sell stops. The whole idea behind sell stops is liquidity. Liquidity basically are orders residing below or above current market price. So sell stops are orders residing below, not above, below current market price. For example, if we have, in this situation, we can see this example, we have a swing low. So from this high to this low, then the market made a higher high. So this is our swing low. Basically, this is the swing low that orders are residing. In another example of a swing low is this one. We have a low, a high, a low, then a high. So most of the retail traders have placed their stops here. So what the market basically does is it comes back and run those liquidity or those stops, or we can say those orders, sell stops, and then run higher. So I've basically told you that sell stops are, it's below every swing low, there are sell stops or sell side liquidity. So I'll be showing you examples in the chart to show you examples of sell stops. So I'll trend this low. This is the first swing low that we see. So we can see that the market came. If you see this low, I want you to look at this high so that you can see that market came and ran that low. The low at this point here, it is 1.10942, and then at this price which came and further ran that price, it is 1.10784. So it is between 784 and 942. So we can see that price came and ran that low, then further pushed higher. So we only need to see, even for market to run, even with just one pip. So that will be sell stops or sell side liquidity being run. So this is the first example, as I was saying. We are going to outline it as sell stops. That is the first example. The second example, I'm just going to clown this. The second example, this, we can see that there are basically a swing low. It is a low, a high, a low, then a higher high. So we can see that price later came and ran those sell stops. So these are the sell stops that I'm basically teaching you about. The second one or the third one is this one. We can see that immediately price comes to these lows, it further runs higher. There's also this one, the next one. When price came back to this low, we can see that it further ran back higher, moving away sharply, or we can say explosively. Yeah, you can also go back to your chart in any time frame. This was the 1 hour. It can also be done in the daily chart, in the 15 minutes. Every time frame you come to identify sell stops, and I'd like you to go back to your charts and I'll try different examples of where market came back down, ran a swing low, and then further ran higher, back higher. Yes, So you'll be able to identify those as your sell stops, and in the next lesson you'll be able to understand the opposing side of sell stops, which is the buy stops. Thank you for listening. Welcome back to this lesson. In this lesson, we'll be learning on buy stops. Below every swing low, there are buy stops or sell side liquidity. So when we have a swing high, I'll be showing you an example of a swing high. When we have a swing high, market goes and creates a swing high like this, and then the market further runs down lower. That is where orders reside. So buy orders. That is a buy stop. So when market comes, with this example, we can see that later further the market came and ran those buy stops, then further ran lower. So let me outline here. These are buy stops. I'll be showing you different examples of buy stops in the market so that you may also go in your own chart and outline examples of buy stops. So the second one we have is this one, which is a smaller version, but basically it came and ran where orders were residing, buy orders, then further ran down. The next one, there are many examples, so go and outline them in your chart. We can see that in this example, we had a high, market ran further down, and then came back and ran those stops. So this is a buy stop order. These are buy stops. Basically here, there were retail orders where there was a trader who came and placed their stop loss. Maybe they were selling and they placed a stop loss above this high, but you can see that since the algorithm knows that there are orders here, it comes back high and then runs further away from those orders. So I advise you to go back to your charts and outline different examples, and then in the next lesson we'll further get to walk further. Thank you. Welcome back to this lesson. In this lesson, we'll be learning on market structure break, which will be used further in the next video or in the next topic to be able to understand further concepts. So a market structure break is a break in structure. So by that I mean, for example, the market has been moving down, has been bearish, but then we have to have the skill to be able to identify when market shifts to bullish. So for example, in this example, I'll be showing different examples in which market breaks the structure. So for example, in this example, we have a swing high, and you can see that in this swing high, the market, we have the market running higher to run above it runs above the swing high and closes above with the bodies above the swing high. So with that, we identify that as a market structure break or market structure shift. We identify that the structure has shifted to bullish. So I'll be showing both sides of the market, where the market runs both shifts direction, both bullish and bearish. In another example, it is here where we see that there was a swing low. As a trader, you have to identify these swing lows and swing highs, and you have to have that skill to be able to identify that. So we can see that here in this market we had a down close candle in an up move. So this down close candle in an up move, in a way, when you come to a lower time frame, you will come to identify this as a swing low. So once this swing low was run out and the market, we can see that the bodies of this candle, which ran this swing low, it ran and closed below that low. So this also confirms a market structure shift or market structure break. Another example we can see is here. We can see that market was running lower, so market was bearish, but you can see it reached a point in which this swing high, this was the first swing high in this down move. So this swing high, the market came and price came and ran above it. We can see that this candle, price closed above the swing high of this candle. So when market did this we identified as a market structure shift. So let's look at different examples of also bullish examples. We can see the next one of a bullish example is here. So we can see that price was moving lower and it created a swing low. So a low, a high, and a low, then market came and ran higher and closed above this swing. That is a market structure shift. We can see that above this swing, market closed above it. Even the next candle, it went higher above this high. So that confirms our market structure shift or market structure break. Another example we can look at is here. This is a bearish example. So market has been moving down, and this was the current swing low in this bullish move. But you can see immediately market came explosively and ran below this swing low. So this swing low was supposed, in this up move, this swing low was supposed to push market further higher and higher. But you can see that immediately we reached this point, market came explosively and ran below this swing low. So when market did that and ran below this swing low, we can see a close below the swing low with bodies below the swing low of this candle. So that is also our market structure shift. I advise you to go back to your charts and outline examples of market structure shift or market structure break, because this idea will be used in the next lesson. So I advise you to go back and do different examples so that you may be able to build that skill and you may be able to have that sight to be able to see this concept of a market structure break. Thank you for listening. Welcome back to this lesson, and in this lesson we will be learning on a breaker. So we have two kinds of a breaker. We have the first one, which is a bullish breaker, and the second one is a bearish breaker. Just from the name, a bullish breaker is seen in a bullish market and a bearish breaker is seen in a bearish market. So what is a breaker? So in a breaker, first you have to identify an area in which market has run either buy stops or sell stops. So we have to have the idea that we have run a form of sell stops liquidity like this one. From the other exercises or videos or lessons, I have been able to show you sell stops and buy stops. So from here, we know these are sell stops residing here in the market. So when the market runs sell stops and then later reverses and breaks market structure, we have also learned on market structure shift or market structure break. So let me outline this so that we may not forget. So when we have an area in which we see that we have run sell stops and then immediately market runs explosively higher to run the swing high or to close above the swing high, that is identified as a breaker. But a breaker is a certain price range. A bullish breaker or a bearish breaker, it is a certain price range in which a price has to come back to or has to break. So a bullish breaker is an up close candle before a bullish move. For example, here we can see that the market was in a downtrend. It was going down, but immediately we ran sell stops and then further ran to close above this swing high and closing above it, then running higher. So we have this last up close candle. This, we can see that here we have 3 consecutive candles before a bearish move, before the market go. So that we had 3 consecutive candles, then immediately price ran down to run sell stops, then immediately we ran further high, running above this set of 3 candles. So that is our up close candle. That is our bullish breaker. So I'll also identify and show you our bullish breaker. So this is our bullish breaker, and I'll also outline it for further future reference. So this is our bullish breaker. I'll also show you a bearish breaker. What is a bearish breaker? A bearish breaker is a down close candle before a down move. So here, generally, let's go to the chart and identify one example of a down close candle, of a breaker. So of a bearish breaker. So a bearish breaker, we have to have run some form of buy stops. Yes. Let me outline some form of buy stops. You can see here there were a set of orders. So there were sort of relative equal highs. Here they were residing buy stops. Let me also outline here so that we may not confuse. So here are buy stops, and we can see that immediately price, after we ran these buy stops, these relatively equal highs, immediately price came down and ran market structure. We shifted in the market structure shift. So I'll also outline here. So here we broke market structure, and it's shown that we have shifted from bullish because the market was going higher, and immediately we shifted to confirm bearish. So this is a market structure shift. So what I'm saying about a bearish breaker now, bearish breaker, it's the down close candle before the down move. So the bearish breaker here, the down close candle, they are this set of, when we have multiple candles following one another, consecutive candles following one another, down close candles, then we have to outline those consecutive candles. So here I'll also outline these candles, and these are our bearish breaker. I'll also outline here a bearish breaker. Hope it is visible so that we may not confuse. Let me outline in a different color. So this is our bearish breaker. Yes. So let's go back to our bullish breaker. So what we anticipate from a breaker is we anticipate a retest back to that area. So in this bullish breaker, these 3 consecutive candles, we anticipate that when price goes higher or moves higher, we anticipate that later price will come back down to retest that zone or area. And we can see immediately that at a certain time in price, we came back and retested this area, and then further market went further to confirm a higher high. We ran back above this high. Yeah, so that is the idea behind a breaker. We can see the other example is the bearish breaker. Let me remove this here. So in the bearish breaker, we can see that when price came and closed below this low and we confirmed a market structure shift, we can see that there was a retest back in this zone. So this retest is where we want to maximize and capitalize in our trade, and for market will further go back down. Let us look at other examples of bullish breaker and bearish breaker. So when we go later in price, we have to identify an area in which market either ran buy stops or sell stops. So we can see here that also in this area we had a set of buy side liquidity or buy stops. So we can see that immediately when we ran these buy stops, market ran further back down towards this low. So that area or zone of buy stops where market immediately ran down, we have to come and look out for our bearish breaker. So this is our bearish breaker. From this example, you are going to go back to your charts and find more examples of the bearish breaker and bullish breaker. So from this example, we have said that a bearish breaker is the last down close before a down move from when price ran the sell stops. So here this is our bearish breaker, these two consecutive candles, and you can see that at a later time when market went and expanded lower, it later came back down to retest that area or zone. So that is what we identify as a bearish breaker. Let us look at another example, the last example of a bullish breaker in price. Let us go and look for an area in which we ran sell stops for a bullish breaker. And then market later came and retested. So we have here you have to go back and do more examples so that you may get the idea of it. So here we had an area of sell stops. So market, we ran sell stops here. Actually it was this area. Yes, you can outline this one, or also you can outline here. So immediately price went high, it broke market structure. This is our market structure shift. Market structure shift, and we have said that it is the last, in a bullish market it is the last up close candle. So this is the last up close candle. Yes, we have two consecutive, so we have to outline them. So we can see that immediately market broke market structure shift, we came back to retest. We came back to this area of the breaker. This is a bullish breaker. So we came back down to this area here at this price, and then we went higher. So that is an example of a bullish breaker. So I want you to go back to your charts, do further examples, more like 10 for example, so that you may get the idea and the hang of it. See you in the next lesson, and thank you for watching. Welcome back to this lesson, and in this lesson I'll be showing you an example of this strategy. So in this strategy we have a daily fair value gap, and this daily fair value gap has not yet been hit, has not yet been retested, 'tested, and we want to see the market retesting it. So we are not interested in what happens after when the market hits it, but what we are interested in is what happens when we are drawing towards the daily fair value gap, before we hit the daily fair value gap. So in this example, as you can see that we have, this is just an idea of what may happen. So we may have a 15 minutes high, swing high. So the market runs either towards the midnight open. We may form the low either at midnight open or even before. It's not specific to what the market can do, or it's not sorry, or it's not a must for it to look like this, but this is just an idea. So afterwards we see that the market starts making higher highs, and immediately we run the 15 minutes swing high, confirming a market structure shift and also the 15 minutes breaker. So when the market does this confirms that the market has shifted order flow, and we want to enter the retest of the 15 minutes breaker, now drawing towards the daily fair value gap. So in this example, we are going to look in the charts for such a bullish scenario in where the market is drawing higher into a bullish daily fair value gap. So let's go into the markets. So what I'm trying to outline here is a scenario in which in the daily chart the market leaves a daily fair value gap. So we can see we have that instance here. We have a daily fair value gap here. So let me outline it in the daily so that we may not forget it. So in this daily fair value gap, what we are interested in, the draw towards it, not after it hits. We are interested in the time before we hit the daily fair value gap. So this is the 11th of September. So we are going to go to the 15 minutes, and here on the left side, we are going to look for the 11th of September, go to in the 15 minutes chart. So this is it. So this is our daily fair value gap, and in our daily fair value gap we can see that this is just an example of what we want to see. So we can see that in the previous day, this is our daily fair value gap, and the Tuesday, because the daily fair value gap was hit on Wednesday or confirmed on Wednesday. So on Tuesday we can see that the market during, this is London, New York, sorry. During New York, we confirmed the low, and then immediately the market started running higher, confirming 15 minutes breaker. So as you can see that the example in which I outlined, it is a bit different from this one in the chart. So you can see that the market confirmed a market structure shift here at 11:15. So as you can see that this example does not align with our time, because yes, we confirmed the low during New York, but when we confirmed the break-in structures, we retested it off session. But unless you are an Asian trader, and yeah, during Asian we can see that we still were in this zone of the breaker, because now the breaker in this situation, it is this two up close candle before the up move. These candles, these two big ones. If you have two consecutive candles, then that's your breaker. So in this scenario we have these two breakers, and we outline them, we extend. So when we extend, we get a retest during the Asian session. So, and during this session, we can see that the market came a bit lower, almost hitting our stop loss. And that's why I like to have, for your stop loss, you add an allowance of spread, because you might find that this is just the broker manipulating the lows. So we can say that during Asian, we got a retest of this breaker, and immediately the market started running higher towards the daily. If you have a look up, you can see that in this example, Asian is when we retested and got our entry. We did not. So the next day, if you are a London trader or a New York trader, you'll wake up and find that the market has already drawn towards the daily fair value gap. So in this scenario, you'll know that the market won't retest because it has already retested the breaker during the Asian. So if you are an Asian trader, or if you want to wait for the market to do all this so that you may enter, that's up to you. I can also see that we have even here during this period, we have these three, actually there are three down up close candles. These are also our breakers. So on the left side of the chart, we can see that this also is our breaker. So we confirmed the break in structure, or the market structure break, but also it was the Asian. So even the retest of it was Asian. So you can see the example in which I drew, it's different from what is seen in the chart. That's why I am saying that example, you have to be flexible. It's not limited to the market will come to hit the low during the midnight session. So this is the midnight session. So the market is not limited to it coming to make the low, this low, during the midnight session, or even the retest. It's not limited to the London or New York. But what we want to see is Asian, London or New York making the retest. That is when we want to, that is when the market is at its most primal for it to retest. So during these other sessions, you'll find that either around 5 to 7, the market may manipulate, and we are not interested in being caught up in the manipulation. So as we can see that in this example, if you are an Asian trader, we want to enter at the high of this breaker because it is a bullish breaker. We want to enter at the high. Let me remove this first. So we want to enter the high of this breaker during the session. So when the market here, we can see it was also off session, but we want to enter at the high of this session zone. So it's around here. So even this high, it was 1915, and we know our Asian session starts at 28 p.m. So here is so when the market hits 28 p.m., you may place your limit order, or have a market limit, market entry. Your stop loss will be here, so it will be 6-7 pips, and you are drawing towards this liquidity, this daily high, which is 26 pips away. So we are only interested in the market to hit this high, to run the previous high, or if you want to leave partials, we also get this swing high, which is around our previous days, our Tuesday's high. So let us see if we hit that high. Yeah, we get a hit, but I think I can advise that the daily high is the best place for you to offset your position. Yes. So that's an example of what the strategy is about. And also you can go in your charts, outline different examples like this. Either when the market is bullish, it's drawing towards a daily fair value gap which is bullish, or when the market is drawing towards a daily fair value gap which is bearish. Thank you for listening, and I hope you understand by doing different examples. Thank you. Welcome back, guys, to this lesson. And in this lesson, we are going to be looking at examples of our strategy and how they occur in the market. So I'll be drawing the idea that you should be having in your mind of how this strategy will be looking like in the market. So first of all, we'll be having a daily fair value gap which has been left in the market. So for example, this will be the daily fair value gap. The market will have left a daily fair value gap, and in this scenario it is a bearish daily fair value gap. So the idea is that the previous day we confirmed a bearish fair value gap. We confirmed, so the market came, ideally this is the previous day. The market came, confirmed a low, confirmed an imbalance in the daily chart, and then later on, today is either today or until the market shows signs of retesting the daily fair value gap, we'll have that daily fair value gap in our minds. So the idea is that we want to draw towards the daily fair value gap. So the market will or should have shown the potential to draw towards the daily fair value gap. So, and in our instance, this will be our daily midnight open. So for example, we have a midnight open, midnight. So this will be our midnight open, and the idea I have in mind is either the market will have, the previous day will have confirmed, will have made a swing low, then drawn towards the midnight open and made a swing high, then later on started making lower lows till we confirmed either the 15 minutes breaker or confirm a market structure shift, then retested it, then this is our draw. So ideally this swing low, either in the mostly in the 15 minutes or the 1 hour, we want to see it broken and then retested. So this is our 15 minutes breaker. Oops, sorry. Yeah. So this is our 15 minutes breaker. So what I'm trying to say is it's not a must for the market to make or to come towards the midnight open to make the high. It's not a must. It may form at any session, but what we are interested in is this session here, in which we find our retest of the breaker. So when the market retests this breaker or confirms a market structure shift, that is when we are interested at a specific time of the day, which is either London, New York, or those who trade Asian. That is when we are interested from the market to retest. So I hope you create that idea in your mind, so that when we go into our charts, we may be able even to see this so that when we go into our charts, we may be able to get a clear picture of what I'm trying to see. Haya, let us go into the markets. So in the markets, we'll look for an example in which the market has made a daily bearish fair value gap. So in this instance, the market should be drawing higher. So for example, here we have this daily fair value gap which was left, and as you can see, on this day on the Monday 5th of August, we confirmed that breaker, but you can see that the next day we did not go to retest that breaker. So but what should be in your mind is, do we get a breaking structure drawing towards the daily fair value gap? That is all you are interested in, because we may also get that the market may continue running higher. So but if we get a breaking structure to the downside, that is what we are interested, and that is how we know that the market will draw towards this daily fair value gap. So let us go into the lower time frame. This was around 8th of August. Let us go into the 15 minutes chart so that we may see what the market did and get a clear picture of this strategy. So 15 minutes, the 8th of August. 8th of August, go to. So where is our daily fair value gap? 8th of August. Yeah, this is it. So as we remember, the market confirmed the daily fair value gap on Monday, and then we did not get a draw on Tuesday. So until the market hit this low, that is when until the market hits this low, we are still interested in the daily fair value gap as our draw. So let us go into the market. We can see that on this day, on the Monday, we confirmed a market structure shift here. So this is what triggers us. This is what triggers that the market will draw towards the daily fair value gap. We can see that the market confirmed our market structure shift, but we did not hit on Tuesday and also on Wednesday. So instead we consolidated. So here I said that when the market run stops, we want to in this scenario we'll be looking for down close candle before the market confirm the breaking structure. So this is it. Let me expand it so that we may outline our breaker well. So this is our example in which this is our breaker. So what we do is extend that breaker towards the left. So we can see that the market we are looking for session zone, either the London or the New York. Some of you may like maybe the Asian, which is okay. So on this day we got a retest at 4:30, and then the market came running lower, but we did not get the market hitting the daily fair value gap. Instead we went back to the 15 minutes breaker. So the market may consolidated here for a while. We can see we also hit at 10:45, but the market consolidated again. The next day we got on Wednesday a retest at 10:30, but the market did not move anywhere, so we consolidated till the Thursday, where we hit again at, it was around, yeah, London, and we see that we had a final hit at 7:45. Oh, actually it is 8. Yeah, around that time, which is our New York session, and then the market ran low. So we can see that most traders in this scenario placed their stop loss here. So the market created an idea, an idea that we want to run higher. So most traders or retail traders place their stops either at this low, any swing low that was created. There were stops which were placed, and that creates a very good scenario for the market to draw lower. So we get that we had multiple retests towards the daily fair value gap on these days. So if you entered on this day, we can see that your stop loss was not triggered. So, and the stop loss for the person who entered here, because we are placing our stop loss at this swing high, it is 20 pips towards this low, which is 40. So you get a 2R. But we can also minimize our risk, and in this scenario we get, on this Tuesday, we got a smaller breaker inside the bigger breaker, which was here. You can see that we came, ran some form of swing highs, and then immediately the market broke lower. So in this instance, this is our breaker. These down close candles, consecutive candles, are our breakers. So, and that's why we got a retest at 8:15, and the one who placed their stop loss, or they made their entry at this point and placed their stop loss at here, say 8 pips, they got their 40 pips. So this is what I'm trying to teach you, that when you go to when you go to look for such patterns in the market, you find that you get very good setups which will, let me say, improve your account and make your trading life easy. So thank you for watching, and I urge you to go back into your charts and look for more examples like this, and practice and practice and practice. Thank you. See you in the next lesson. Welcome back to this lesson, and in this lesson I'll be showing you examples of the strategy and every other aspect in which we have learned so far about the fair value gap, the breaker, the market structure shift. We'll be integrating all of them to be able to understand how the strategy works. So this is just a layout of an example of how the strategy will look like. So for example, you are going to find that you have the daily fair value gap, and at that daily fair value gap, first the market will not have retested the daily fair value gap. So the draw will be the daily fair value gap. So in this case, in this first scenario, the market will be drawing towards the daily fair value gap. So as you can see how I have outlined, we'll have the daily fair value gap, which either was left the previous day after market confirmed the daily fair value gap, and this line shows the midnight open of the market. So whatever I've drawn here is not generally always how it will look like, that the midnight open will be like this, but this is just an example of how the strategy will look like. You can see that this is a 15 minutes fair value gap high, a swing high of the 15 minutes fair value gap. So you can see that the market draws down towards either towards the midnight open or hits during the midnight open. It's not limited to the midnight open, but this is just an idea. It's not specific to this this diagram that I have drawn. So as you can see that this is the high, swing high of the 15 minutes. So the market comes and breaks that and confirms a market structure shift in the 15 minutes, confirming a 15 minutes breaker, then runs towards the daily fair value gap. So as you can see, this is an example of where we have a draw towards the daily fair value gap. Another thing I want to say about this example is you'll not have every time the market confirming a 15 minutes fair value gap. We may see that market may come and start reversing using creating higher highs in the market. So instead of even having the 15 minutes breaker, we may find that the market will start to create higher highs until it reaches the daily fair value gap. So what we want to see, in short, is a situation in where the market creates a run on sell stops. You can see this example is a buy example as we are drawing towards the daily fair value gap. So in this example, we are going to look at we are going to look at different examples in the chart, and I have said it's not limited to this how I have outlined it, but you will get the idea once we see many examples or different examples in the market. So let us go into the chart and find such examples as this. You can see, as I have said, that the draw is towards the daily fair value gap. We have not yet hit the daily fair value gap. We have just formed it. So you know that the market will draw once it breaks the 15 minutes breaker. So let us go and look in the chart for such examples. So the first example is this one, which occurred. You can see that in this example we had a daily fair value gap which was left on Wednesday 21st. First, let me say that you won't know that the next day the market will come for this daily fair value gap, but what will help you to know is the break-in structure. So the break-in structure in a lower time frame, for example, we'll look at the 15 minutes. That is what will help you to know that the market now is drawing towards the 15 minutes, towards the daily fair value gap, So we can see that this day was on the August 22nd. So let us go to August 22nd. August 22nd, go to in the 15 minutes. So let me start by clicking the 15 minutes. Then go to August 22nd, go to. So as we can see that here, this is how this is the daily fair value gap. This is the daily fair value gap, as you can see. Then in the 15 minutes, we have to look for a market structure break or a situation in where the market runs buy stops, because in this example we are looking for this is a sell setup. The one I shown you in the diagram was a buy setup. So we'll look at both sides. So we can see that in this scenario that the market the previous day created a high at 1430. Later on, we created another swing high at 1915. But what we want to see is a scenario in which the market comes and runs some form of buy stops. Then let me outline it. Buy stops. So we come So you can see that we have run buy stops, then immediately market confirms a market structure shift here, and we can, as you can see, I had outlined the breaker. So you can remember that I said a breaker is the in a down move, a breaker is the last down close candle in an up move. So no, a breaker in this scenario is the last down close candle before the market moves lower. Yeah, so as you can see that this candle is the last down close candle before the market ran higher to run buy stops, then immediately it reversed. So the reason as to why I've chosen this is we have this one and this one. So some of you may come and select this one, but the one you want is the beefiest candle, yani the one with the more bodies. So even you can select this one, you can also select this one, and also I can select this one. So the one with a more bodied candle than the other one. So some of you may come to choose this one or this one. And the high, the stop loss, now our stop loss will be placed here at this high, at this swing high. So yeah, let me outline it as the stop loss. So this will be the stop loss. So at this stop loss, this is where and you can see I've added some pips. This is just for spread, yeah, but also even though you placed it here, there, we can see that the market also did not hit it, because what we are looking at is to enter during session zone. We said that we wait for the market to come and hit it during session zone. So we can see that the market confirmed the market structure shift, and then we wait for kill zone, either between London 2 to 5 or New York 7 to 11. So during this session, this zone, it was 6:45. So as we can see that the high of this candle, it came to hit our stop loss, but we know that we do not enter our trade during 6:45 or this zone, because this is the London lunch and we are not interested in entering during this session. So we can, as you can see, that the market came during the New York session again and hit the London and hit the breaker. So we can see that during 8:45 and 9, even almost at 9:15, we were just hanging around that breaker. Then immediately the market went lower. So what we want to see is our stop loss being preserved. Even here you may get that, for example, maybe it may be the broker who spiked up, because some of the brokers, the highs and the lows, they're the ones who determine such things. So for example, in this scenario, our entry point will be here at the low. We are just interested at the low of this breaker, and then the stop loss at this high. So that's around 6 pips, and we know that we are targeting the daily fair value gap. The reason as to why we are targeting the daily fair value gap is because there's this liquidity from the previous day. So this acts as a magnet for the market. So the market is attracted towards this liquidity, towards this low. So even if you placed your take profit here, that's okay. The reason as to why I can say that we are not interested in, because we know that we are not interested in the market coming to fill yes, the market sometimes feels that, but the reason we are not interested in the market going any further than this low is because this is where our liquidity orders, this is where orders, most people's orders are, and this is where we are interested in to pay out our sales. Yeah, so we are going to look at another example, and I urge you to go into your charts and look at different examples so that you may get the idea of what this strategy is about. Thank you for listening and for watching. See you in the next example. Welcome back to this lesson, and in this lesson we'll be looking at our strategy and how it works. So we'll be looking at an example in which the market is moving away from the daily fair value gap. So in this example we'll have a scenario like, so it's a bullish, we'll be moving away from the daily fair value gap. So the daily fair value gap, and the idea is we want to see what happens when we move away from this daily fair value gap. So the idea is we have drawn and hit the daily fair value gap. So what happens next? So in this idea we may get that the market hits and then starts making lower lows like this. So in this scenario we may get a run back towards either this swing high. So we may get an idea like a scenario in which we run maybe the high, then makes a lower low. Makes a lower low. Let me repeat that. So we have drawn towards, we broke lower, move back up, then run the buy stops, break structure, retest, then moves away. So moving away, we'll be looking for the market to run the previous day's low. Yeah. So this is the idea, and here we'll be having our breaker. We'll be having our breaker retest, then moving away. So let us go into the chart and look for such a scenario. So when we go into our charts in the daily fair value gap, we get let's outline this one. So here we get a scenario in which we hit a bullish fair value gap, and then we want to see it moving away. So in this scenario, in the daily fair value gap, let me outline so that we may remember that it is a daily fair value gap. And on this day, we now get back to, we go to the lower time frame on the 11th of September. So 15 minutes chart, go to the 11th of September, go to. So what happens? So in this scenario, as I outlined, we can see that we came, hit the first time, moved away. It made a lot of swing high and lows. So we can see that the market consolidated. We got back here again, here, retest, then made a lower low, and we are targeting the previous day's low. So we can see that this is what it did. So in this scenario we can see that when we hit at 115, the market immediately made a lower low, but we did not get a break in structure. So we are interested in when the market breaks structure. We can see here again we tried to run higher. Did we get a run above this? Yes. So we ran, broke lower, but the market did not, but the market moved back up, then consolidated. We got a consolidation, then back again higher. So I can say that in this scenario, we did not get a market structure shift, because as we see this low, the market did not close below this swing low with their bodies. So that is what this was just a run on stops. So here we did not get a break in structure or a market structure shift because you see this swing low. When we came back here low, we came back here again, the bodies did not close below this swing low. So this should have triggered you not to enter, even though, because you can see that this was at 4 p.m. This is a 4 a.m. This is our kill zone. So the next time we came, we ran back up. We ran the buy stops, then started breaking lower. So maybe ideally you'd have wanted to see this low being run, but we can see that the market created a shift in market structure by creating an imbalance. So this is just another example of what the market may do. It made an imbalance because we see, I think we had a news event, so the market came just running lower. So if you are a trader and you placed a limit order or a stop order below here, it would have been triggered and then you'd have sold in this market. But we can see that in this scenario, we created an imbalance, which was also okay. And an imbalance shows that the market has shifted order flow. So we can see that we got a retest back. And we can see that the time is during a New York session. So during this session, when we got this imbalance and the retest, this is where ideally we are interested in entering and maximizing our opportunity, because you can see that this scenario will place our stop loss here. We'll place our stop loss here and not at the breaker, because we have not yet confirmed the break in structure. We have not yet confirmed our breaker, but if you placed your limit order here, then the best scenario would have been to place your stop loss at this. We know that the breaker is there. In this scenario, it will be the 2 consecutive down close candles. So this would be our breaker. Outline it, extend. This is our breaker. And here you would have placed your stop loss here. So let us imagine that maybe you entered. So stop loss at 7, 8, and you're targeting towards the previous day's low at 24. And we saw it, and it even went further, but we are just interested in making the market running the daily lows and capitalizing on it. So also, if you entered at the daily, the 15 minutes fair value gap at the shift in order flow, your stop loss would have been at this swing high 11 and targeting these lows at the previous daily low. So I urge you guys, this is just examples. So there are many examples in the market. Even there are many examples in different charts. It's not limited to the euro dollar. You can go to different pairs, find for such scenarios where the market has hit and we want to get a move away. So what we just want to see is, do we create either a break in structure by creating a breaker, or we can see do we see a market structure shift where the market has created an imbalance. But you can see the reason even behind this move away, or this dynamic movement away from our daily fair value gap, is the market ran the buy side liquidity of the London session and then moved away. So, and also I think here we had some news. So I think this is also what triggered for the market to retest and not either make a retest of the 15 minutes fair value gap. So that is it, guys. See you in the next lesson. Welcome back, guys. In this lesson, we'll be looking in a scenario in which the market will be drawing away from the daily fair value gap. So the example is The example is, let me remove this first. So in our example is we'll have a daily fair value gap. So we'll have this daily fair value gap, and now the market will, it's after we have hit that daily fair value gap. So I'll outline, maybe for example this is our midnight open. So I'm sorry, midnight. So this is our midnight open, and it's not limited to this, what I'm trying to show you, but the market will create different scenarios. So it's just that you get the copy or idea of what I'm trying to say. So the market will have hit the daily fair value gap, and now we are trying to draw away from it. So for example, as I shown you the other previous examples in which we created this scenario. So we retested, we hit, but after hitting, what happens next? So in this scenario, we may get a hit into the daily fair value gap, then the market makes a lower low, then we break market structure, moves back to this area, then we move away. That is the idea of what we want the market to do. And as I've said, it's not limited to what I'm showing you. We may get other ideas. The market may create different scenarios. So this will be like the 15 minutes breaker. So the market may create different scenarios here, but the idea is when we hit, what happens next? So when we hit, we want to see a confirmation in the breaking structure. So when we get a breaking structure, we want the market to move away from it. And moving away from it, this is our trade setup, and the strategy is about this. So let us go back into our charts and look for such examples. So in this scenario, we are looking for the market to bounce and to move higher. So for a bullish scenario, so let us go and look for examples. So this is our daily chart, and what we are saying is for the market for a bullish scenario. So this is it. Let me outline this one. So in this one, let me start with the lower one. So in this one, we get that the market hits. So what happens after we hit, or what normally occurs, or what's the idea that we want to see when the market hits? So this is the 19th of September. Let us go to the 15 minutes chart first, or the 19th of September. So in the 19th of September, this is ideally what we have. So the market hit. What we are interested in is what happens when we hit the daily fair value gap. So our next idea, or whatever we'll be asking ourselves, is, do we get a break in structure? Do we get a market structure break? That is what you want to see after we hit the daily fair value gap. So in this instance, we get here, this is our swing high, and in this swing high, this is where our market structure shift occurred. So this is our market structure shift, and we can see that the market expanded higher towards this daily high. So this is our previous day's high. So what we are interested in is for the market first, when it is moving explosively or dynamically away from the daily fair value gap, we don't want to see the market running this daily high. So the daily high is where we said we have pent up on orders. So most of the, say, let us say little traders, some of them have placed their stop loss here with the idea that the market is going bearish. So this is where the market will come seeking for orders to pair with. So we don't want to see the market running the daily highs. What we want to see is an idea like a scenario like this, in which we get a move towards the daily fair value gap, but we fall short of the daily, we get a move towards the daily liquidity, but we fall short of the daily liquidity, and then later on the market will retest this area in which we broke our structure, which is our breaker. So our breaker in this scenario, it is the last up close candles before the down move. No, last up close candle before the up move, where we broke our structure. Yes. So in this instance, we get these 3 consecutive candles. So when you see that the up close candle are following one another, those are, you outline all of them. But when you get a scenario in which it is one, you outline that one. So the reason as to why I'm not outlining even this one is because as you can see here, we got a down close candle, then we form this up close one. So we are not interested in these ones, but we are interested in this one, and here is where our stop loss should be, here below this low. So below this low, that is where we want to place our stop loss. So this is our stop loss below this low. So what we do, we extend. And what I said is we want a retest of this breaker during session zone. So either during London or New York. So as you can see that during, this was 9:30, we got a retest of the breaker. And as I said, our stop loss should be here. As you can see, we did not hit it. And then where we are targeting, we should be targeting this previous day's high. First this swing high, then also this previous day's high. That should be our target. So once the market hits it, we just extend. Once the market hits, that is where we want to offload our setup. So as we can see, the market did not go to that daily high, this daily high, but first we got to hit this daily high. So what I would have preferred is if the market was running higher, not on this day on Friday, but on this Thursday. If we got a run beyond here, then the market would have come here. But since we open on a new day, this now became a daily high. So the market capitalized on this daily high instead of this one. Remember what I've said is, on this day on Thursday, our ideal place to exit would be the previous day's high. But since we got a run towards this high, but we did not, the market made sure that we closed the next day, we closed that day before running it. So this became our new daily high. So this new daily high is where we want to exit our trade. So we are not interested, it's not a must for, even if you placed your exit here, but you have to remove your partials, because you always remember that the trader has to be paid. So let us look in this scenario. Even if you entered at the high, for example, you entered at this high and placed your stop loss here, 10 pips. By the time we are reaching here, it is 50. So what I'm trying to say is, once this day of Thursday closed, we made sure that we closed the day. The next day, you have to have in your mind that there's a possibility that the market will not draw towards this Wednesday's high. But since we have created a new daily high, that is where we want to capitalize and exit our trades. So remember, always pay the trader at the nearest partials, at the nearest swing highs. So for example, in this scenario, we got 38, there was this swing high. There was this new swing high. There was a swing high created here. First, you would have exited some parts of your trade, and then the next day, since we opened in a new day, this is where you want to exit your trade here. So even if you placed some and left some of your trade here, it's not wrong, but what would have triggered you to know that the market is not coming back to this swing high is when we ran the previous day's high and we started breaking the market structure. So when you get a break in structure, a market structure shift like this, here we started breaking lower and making lower lows here. So this is where you want to exit your trade. Yeah. So if you had not closed this trade, once the market started breaking market structure to the downside, this is where you would have known that it is in your best scenario to start removing your trade from this trade. But what I may say is, you got a clear 5R towards this high. So why not exit in the nearest daily high? Yeah, I want you to go back into your charts and look for such examples so that you may get familiar with this strategy and you see that this strategy, it works. Thank you for listening. Thank you for watching, and see you in the next one.
Welcome back to this lesson. In this lesson, I'll be showing more examples of the strategy using a different pair. And today we are going to look at the pound dollar. So in the daily chart, I've outlined different daily imbalances in the chart. So I'll start with this one. So on this was the 17th of October 2024. So as you can see that we have a daily fair value gap which was left open once the market confirmed. Yeah. So we'll be looking at the perspective in which the market was drawing towards the fair value gap first. So when the market was drawing towards the fair value gap, as you have learned in the other examples, either in the 1 hour or the 15 minutes, we'll look at the breaking structure, a market structure shift, then be able to identify a retest of the breaker. So we'll go to the 15 minutes of 17th of October. So 17th of October, it is here. Go to, I've not outlated the 15 minutes, sorry. So go to 17th of October, yes. So, and we can see that the daily fair value gap had not yet formed, because we can see that on this Thursday, it is when the daily fair value gap formed. So it means before the fair value gap was left open, the market had already started drawing upwards towards the higher. So we have not yet formed the daily fair value gap. So, but the market is already moving higher. So let us look at that example. So we can see that here on this day, the market ran some form of sell side, which was yesterday's low. So that is number one. We ran some form of sell side. Yes, I was looking for here. So sell side liquidity. Oh, it is too small for us to see. So let us go and adjust the coordinates. Hope it will be a bit bigger. Yes. So as you can see, we ran some form of sell side. Then what we are looking for, did we see an immediate market moving away from that sell side towards the opposing side and breaking market structure? So that is what we are looking for. So we can see here there was also this sell side liquidity. So what we are interested is here. This is the market structure shift. Oh. Market structure shift. So okay, so the importance of as I was saying, of journaling or annotating is, for instance, for me, I don't prefer to the market to break with or to close higher above this without bodies. So as you can see, this is just a wick, and you know that wick are gap. A wick is a gap. So imagine, let me go and to the settings and show you what I mean. So when I close this or remove this wick, you can see what I'm saying is the market did not break the structure above here. It did at this point at 5:45 here or here at 6. So when I remove the wick, the reason as to why I was saying a wick is a gap is it's just a level of inefficiency. So I don't prefer to see this part, the break-in structure, just being removed by wicks. I prefer to see bodies. So let me return the settings of, where is it? Oh, symbols, yes. So when I return it, so I prefer to see bodies. So for instance, in this side, we can see that the market came back down again and then ran higher. So at this point this is where I'm interested, not here. So the importance of journaling is the reason as to why I was telling you to have even a book to write these things is when you begin with this strategy, you maybe ask yourself, why not consider this week? But I've already answered that point, that a week is a gap. So when you close, just imagine like it is a place where the market came and immediately ran back down with it's a place of inefficiency. So that's why I prefer the market to come back again and close higher with bodies. So as you can see that the market later on at 6, it broke the structure and continued running higher. So this is very good for us. For then the next thing, you wait for the retest. So the retest and the breaker that we're interested in is this body, the up close body before this down move. So this is our breaker. Extend it, outline it as a breaker. Yes, you can see here also another question that you may ask. Look that we have the wick has gone also down, but what I'm saying is look at the bodies are up above. Even though we came here a bit lower below the consequent of this midpoint of the breaker of this body, but the body is respected this breaker. So even if you placed your stop loss here, you may re-enter. So, and we are also, remember, we are factoring our time zone which is between 8 to 10 to 11, sorry, to 11. So we can see if your stop loss was hit here, maybe you had placed your stop, we had set somewhere there with an allowance of around 2 pips, so maybe here. So if that was your stop loss, so if that was your stop loss, it would have been hit. So this is also another important lesson to write in your journals, because sometimes the entry level in which you enter in, you find that the market will come and hit, but not all the time. It is just a low probability, maybe out of maybe 90 out of 100, maybe 90% it will not come below the breaker, or maybe let me say 95. So it's like a one in a in one trade, in 10 trades, maybe one trade will happen like that, but I'm not saying it will always happen like that. So but it's up to you to go into the market and test it during your back testing time or forward testing, so that you may know or you may have the confidence to re-enter. So at this point you were hit at 9, but you can see there was no other point that the market came below. So at 9:15 you could have re-entered, at 9:30, 9:45 we hit again, 10. So look at the time in which the market hits. Since 8:30 we hit, the market kept revisiting that area for 2 hours 45 minutes. So if you entered at 8:30, imagine you'll be staying, the market will not have moved from that time for 2 more hours, almost 3 hours. Yes, but later on we get a run above our high. Yeah, so I hope you get the hang of it and practice, so that you may be able to understand these concepts. That's it, guys, for this lesson. Bye. Welcome back to this lesson. In this lesson I'll be showing an example of the strategy, and in this instance we'll be looking at when the market is moving away from the daily fair value gap. So we'll have hit the daily fair value gap and the market will be drawing away towards it, away from it. So in the daily chart, outline your daily fair value gap. Then the second step is for you to now narrow your focus into a smaller time frame. So in the smaller time frame, I'll look at the 15 minutes. It was the 17th. So from the 17th, we have our daily fair value gap. So we can see that the market rallied above, even beyond the daily fair value gap. But does that mean that we lose our interest in it? No. So what we want to focus on is the next step, which is, does the market first run, because we are looking for market to start turning away from the daily fair value gap, so the market to shift direction towards selling. So we are looking for some form of buy stops to be run, then the market to break structure. So as you can see here, the market rallied above. That is okay. And this is the importance of backtesting, because when you go live trading direct, you will question yourself whether the market will actually turn, because you have seen the way it has explosively moved above the daily fair value gap. But when you practice, it's when you'll know that you have that idea in your mind, and there are certain things you'll be looking out for. So when that occurs, yes, you'll know it. So that idea will not have left your mind. So at this instance, we can see it made the high at 2:15, which is good because it is within our time session, which is the London session. But we did not see any instance in which the market ran a buy side. So even here, when we look at the Wednesday's daily high, we did not run the Wednesday's high. So that is out. So the next one we are looking at some form of buy side. So the next time that we look at, we see that the market has ran some form of buy stops is at 9:30. So we can see here market consolidated, yes. Then so these are buy stops. So we ran buy stops. Then what happened next? We broke market structure. We had a market structure break. So at this instance here, okay, some of you will outline here, which is okay, as the market structure shift. But also some we outline here, which is also okay. It's up to you. It depends with you. So whichever is okay. So we can see that we got a retest at 11:30. So we can see that is an off session time. So that's the reason I can say that market did not move anywhere. We just consolidated. So we are interested at the session. So let me outline maybe the next day's session, starting from 2 a.m. 2 to 5. So that's our London session. So within that period is when we are interested to enter on the retest. So we can see that the structure was not broken, because if your focus was the down close candle before the up move, so this is it. You outline it as our breaker, extend it. So that's our breaker. Oh, I've seen that we also ran a secondary form of buy stops. Okay, it's not secondary, but some other form of buy stops. Here we ran buy stops. Then we also had a market structure shift here. So it occurred here at 2. Yes. So at 2 we also had here the break in structure. Then we can see, so for this instance in which we have an imbalance, it's not okay, it depends with the pair, but we can see here that the market did not get to enter into this fair value gap, but that's okay because there's a high probability that the dollar came and retested. So you have to have the both pairs, the pound and the dollar, so that you may be able to connect between the two to see when the retest is occurring at the dollar, do we get a hit? So even at this example, go and look at the dollar. Did we get a hit here? And if not, it's still okay, because at this low, the low was at 1.30392. What was the high at this point? The high was 1.3038, and here 1.338. So it missed with 1 pip. So, and that is, sometimes it's the result of the breaker, sometimes it may not be accurate, be perfect. So don't also expect perfection on the retest. So that allowance of between 1 to 2 pips on the retest, that's where sometimes you may miss, and it's not good for you to miss, for you to be waiting for a whole day, a whole week, because you can see that the market closed on Friday. So imagine you waited for Saturday and Sunday to miss the setup on Monday after waiting because of just 1 pip. So I also prefer to place an allowance of 2 pips in the entry or 3 pips, so that you may be able to be picked up by the market. So, but when we look at this one, the retest, it occurred here off session. So yeah, this happened off session. But anyone who there's also this one, this breaker, for those who consider this as their breaking structure here. So you have to focus on either of them. So both scenarios will give you an entry. Yes, so we got a breaking structure and the retest within our time session. So you can see all of this is just consolidation, and just imagine. So the key takeaway I'd like you to think about is, just imagine that all this data, or because this was not during the session, imagine if this whole data, we blocked it out. Let me place a shade of black, a deeper black. So imagine all this data is not here. Okay, up to the time session. Up to the time session was here. Yes. So just imagine that all this data was not here. So it's just time distortion. But what your interest is focused on is our time zone. During our time zone, do we get a retest? Is the market still at that area of our breaker? So that is what we are interested in. Yes, so we can see we get a retest here, multiple entries. So at 2:30 you can get your retest, and if you have not entered here and you see that the market has started moving away, I can say as long as we have not run this low, you can narrow your focus into a lower time frame and enter on any mode of entry that you can get, which is either the fair value gap, or you may get a smaller breaker in the lower time frame. Yes, so you can enter either on the fair value gap in a lower time frame, but as the market is drawing towards the sell side, so you get that opportunity. Yes, that's it for this lesson, and I'd like you to go into your charts and do more practice, back test, forward test. Try to, yes, forward testing is when you go into a live chart, not execution, but a chart which is printing, which is live, and then you get these ideas, you see it manifesting, you see the strategy coming to and manifestation, then you try to enter it. Yes, that's it for this lesson, and see you in the next one. Thank you for coming back to this lesson. So we are going to learn how losing 1% of account, losing 1% of account, and how to mitigate it. So what happens, or what can you do when you lose 1%, 2% of your account, and how can we mitigate it? So first we have to frame setups of 2:1 and higher. So imagine from the calculation that we had on the previous video, imagine framing setups of 2:1, 3:1, 4:1, 5:1. If you frame setups that can be able to achieve
a high risk to reward ratio and higher from 2:1, 3:1, then as we saw, you can be able to recover and mitigate the losing trade. The next is what happens when you lose that 1%. So the best advice or the best way we can manage is you reduce your risk once your stop loss is hit on the next trade. For example, if you are risking 2% of your account, so when you lose this 2%, then to the next 1%, so the next trade, you only risk 1%. If you lose also this 1% in the next trade, then reduce your risk to 0.5% and on, so that you may be able, eventually you'll be able to mitigate that loss, because you know also you have a strategy that works, you have your own system that works, and you have accepted the risk. So you can imagine if you lost 2% of the account, and then in the next trade you also risk 2%, or you risk even higher. Some may even increase because they see that the next trade I'll be able to make it, I'll be able to run in profit. So as for you to gain consistency overall and in the long term in trading, the best way is to reduce your risk once your stop loss is hit on the next trade. So as new traders to know that it is good to go back to break even. So yeah, to break even and then relax, regroup, especially if you are late in the week and you have been trading all week. So imagine that maybe today is on a Thursday and you took a loss. So the best scenario would be, you know, for example, if your strategy or your system does not allow you to trade on Friday, I can say just make sure that either if you find any other trade on that day, depending on your system, what your system says. So if you find another trade, as we said, reduce your risk first, then enter the next trade in which you'll be able to recover that percentage that you've lost. Or you can also just wait for the next week so that you may regroup, you may relax and come with a clear mind. So, and also you may, if you are able to, if you trade on Fridays and you find that setup that will be able to make you enter into a break even, then that's good. You don't have to aim higher, but as long as you have come back to break even, that's well and good for you, and it will be able to, overall in your trades, you'll be able to gain that consistency even long term. So you have to factor in if we are late in the week, if we are early in the week and you have taken the loss. So if you are early in the week, then you can continue trading, but depending on the measures that you take. So you either reduce the risk early in the week, then you continue. But if you are late in the week and you find a trade that can mitigate that loss to break even, then you can take it. But if you lack, or if your system does not allow for you to trade on Fridays or late in the week, maybe Fridays, then you may just sit back, relax, wait for the next week, regroup, re-strategize. Okay, you already have a strategy, but relax and regroup, then come back to the next week and you'll be able to come out of any losses. So that's it for this, guys. That's the end. I hope that this will be beneficial to you and you'll be able to see that how losing even 1% or 2% of your account should not affect how you can be able to handle it and how you can mitigate it. Welcome into this video. I want to thank you for completing the strategy course that you have taken in the Udemy program, and also I want to thank you for reaching this far. And now that you are done with the strategy and you want to take your trading career into the next level by learning more, I have a complete detailed course
in my website where I teach more details of ICT concept in the course. So you'll be able to access the course through my website, melafx.com, where I urge you to purchase and enroll in the complete course, where you can also grab the offer which is currently running at $49. So if you search for melafx.com, you'll be able to find this offer. Currently, you can grab this offer at $49. I also urge you to enroll into this course because you'll be able to learn ICT concepts, and also you will be able to get into deeper details of trading. So here you'll be able to create your own profile and be able to access the complete course. Also, you find different payment methods that are outlined, and you'll be able to pay through this method. So I urge you to enroll and to grab this opportunity, as this offer is currently running. Welcome back to this lesson. So we'll be discussing how to overcome losing trades. So as a trader, we have to come to a point in which we learn how can we overcome losing trades, because let me say that losing a trade, it's part of doing business. So but there comes a time when you may lose a trade, but it may come and affect your performance of the next trades. So how can we overcome losing trades? What's the mindset that you should come into with as a trader? Either you have not engaged, either as a new trader, either you have not gone into live, or as an experienced trader, what is it that you can do to help you to overcome losing trades? Maybe the reason as to why you are a break-even trader is because you lost one trade and that trade impacted your performance in the long term of your outcome of the trades. So how can we overcome losing trades? So we have to understand that there are primary trading fears. So, and these trading fears that which most traders face, and let me say that some have been able to overcome them, but some have not. So we have to understand that there are trading fears that a trader may face. So like being wrong, you can come and do your analysis, but because maybe you have not yet practiced and gained consistency, maybe you jump right into taking the next trade, or you have seen a setup looks like your strategy, but you come and jump in, and maybe the first trade you lost, but maybe the next one you went back, reevaluated your strategy, but since the first one you saw that it looked like your strategy, but you failed, or maybe the trade did not go as you planned, so the next trade you may feel like, what if I am wrong? What if, because I did the same thing that I did the other time, what if what I'm doing right now is the same and maybe I am wrong in my analysis? So we have to understand that some of the trading fears that a trader faces is the idea of being wrong. And I can say how we can overcome it is by, first of all, you practice. Then I can say don't jump right after you have seen, maybe you have gone into your studies, you have just learned about a strategy, then you jump right into trading. So I can advise that you don't do that, but instead sit, just relax, because the time in which you come to earn money, it is longer period than the time in which you want to practice and you want to discipline yourself as a trader. So how to avoid being wrong is by doing more practice and exercises, and then through demo practicing you can be able to enter trades. You demo practice for a period of time, maybe 3 months, 6 months, until you see that you have gained consistency. So the next one is losing money. So some traders face the idea of, what if I lose this money? So but you have to know that as a trader, you cannot trade with money that you have not, you are not willing to lose. So that is what you have to understand. Then every trade, you have to calculate the risk that you are willing to lose, so that it may not impact, or you may not feel that fear of, what if I lose money, because you have calculated your risk. The other thing is missing out. So this comes as a result of, you have seen a setup, then you see that either the market has rallied away and has not yet given you your entry point. So what do you do after that? So most traders, they jump right into the market, even after the market has already expanded. And you see, this makes the market to catch your stop loss. Let me say catch your stop loss, or your stop loss may be hit because you may come and place a tight stop loss, or you may have entered or miscalculated your stop loss, or maybe you entered very much. If you are selling, you entered deep into discount, and as you know, as traders, we buy at a discount, sell at premium. So always wait for that price range, for that price move to come back to you, because it will always do. So even in the fear of missing out, you should be able to question yourself and ask, which is my entry point? And after my entry point, when should I anticipate that the market will come and give me an entry opportunity? So when you practice, you'll be able to know that the market will never leave you. The market will always come back to you, and that is where you want to maximize and find your optimal trade entry. So don't fear, or don't have that fear of missing out in your trades. The market will always come back to you, and if it goes, then let it go. There's always an opportunity tomorrow. Today, if you don't find an opportunity today, and maybe the market rallies away, so if the market rallies away, then let it go. Tomorrow, there's an opportunity. The other thing is leaving money on the table. So some traders see that, for example, they have entered into a very nice trade, but the instance come when the market continues to rally, and maybe they see that, this market will continue expanding. This market will expand further and further. So they fear that I'm leaving money on the table, but you never know what the next. So if your trading strategy says that you should exit at a particular sell side liquidity, or at a particular liquidity, then do it, because practicing and disciplining yourself to always maintain your strategy, that is the way to maintaining and achieving consistency. So don't feel like you're leaving money on the table, because when you continue having that track record of success, even though you leave that money on the table, but you have made something, eventually after certain couple of days, it will always come and make sense to your account. So the next one we'll look at a trader's mindset. So what's the mindset that we should have while trading, while we are in a trade setup, so as to overcome losing our trades? So first of all, let us as a trader be confident in the face of uncertainty, and this confidence comes from your practice. So how can you say that you are confident, whereas you have not even achieved success or made a track record of success in your demo account? So that track record of success will make you to feel confident, and even though you are faced with uncertainty, you'll know that I've practiced this for a period of time and it works. So even though you come to lose a setup or a trade, you'll be able to know that the next one, because I've done it again and again for a couple of period of time and I've gained a track record of success, then you'll know that tomorrow I can do it. So it's not about today, but it's about the general outcome of my trades in maybe in a month or after a certain number of trades. So also as a trader, you should be focused. Yes, you should also accept your risk. So accept the risk of the money that you are risking. Accept it. That know that every time you enter into a trade, know that when you have placed that buy order, when you have placed that market order, that money is not in your account. So always know that when you have placed that order, market order, limit order, stop order, know that market is not in your account. And so you have to be aware that you have to know that, am I willing to risk that money that you have deposited and you have risked in that particular trade? Also, be disciplined, because of course discipline brings out consistent traders, brings out consistent traders in the end. So be disciplined with your strategy, with your model. Then the other thing, no impulse trading. So don't just jump in, or maybe because you think of a certain idea, don't just come and impulsive enter that trade because of either you feel you have been left out. No impulse trading, guys. So always follow the strategy, follow the rules that you have put in place. So how can you be consistent? So consistency comes when you have a system. Have your own system, and that is, have your own edge. What is it? What is that you have found in the market that makes you different from the others, that makes your trades unique, that makes you to see a record of success? So that's your own edge. Whatever system that you have put in place that is able to make you earn an income through trading, that when you follow it day by day, every day, if you know you are not supposed to trade on Mondays, maybe you have set in your system, this system does not apply on Mondays, does not apply on Tuesdays, then what are you doing trading on Monday? What are you doing trading on Tuesday? If you have said that maybe in the time session I'm not supposed to trade between 5 to 7 a.m., then what are you doing engaging in the market at that time? So have your own system and trust your own system. And how can you trust your own system? It is when you see it working, when you see it having made you a record of success, even through demo, because the demo is one of the best place to practice before you enter into live. Then the other thing I can say is accept the risk before you enter into any trade. As I have said previously,
that before you execute, before you place that order, know that that money is not in your account anymore. So that's the risk that you face when trading, that you are giving out your own money before you make anything. So after you have made the money, well and good, but before that, always know if you are willing to risk that trade. So for others, you may find that you have an account of maybe $100,000, but you have never even had such an account before. So when you come to risk maybe 1% of that account, you feel it's so impactful on you. So the best is to maybe try to reduce the risk, the risk, or maybe find a smaller account so that you may get familiar and grow from there on. But if you are willing and you can accept your risk and your own system works perfectly, then even some, we know that we risk 2%, 4%, because you have accepted the risk that comes with risking that particular percentage. Yeah. So that's the end of this lesson, and I hope that you are able to overcome any losing trade, because trading or losing is part of doing business. It's the cost. Losing a trade is the cost of doing business. It's the cost of gaining more information from the market. That's it, guys. Hope you are not hindered, or you don't have a mentality where you are stuck, but you are able to come out of any shell that hinders you from making money in trading. So if you have any question, you may message me, and see you in the next one. Thank you. Welcome back to this episode. This is just a thank you note, a thank you message for you, listener, who has taken the time to go through that strategy. I know it's not easy to purchase things online, but thank you for purchasing this course, and I hope that it has been helpful to you. Just hope that you do more exercises. That's what will help you to be profitable using this strategy. I also want to thank you for taking your time to go through the strategy. It means a lot. So thank you, and have a nice time.